In this video, I'm going to reveal to you an easy, smart money concepts trading strategy that you can use and implement today. Pay close attention because I'm going to be sharing with you a very important pattern, and this is the master pattern. The master pattern is basically this three-phase cycle that happens in the market where we get contraction, the contraction phase, and then we get expansion, the expansion phase. And then we get the trend phase, which is the third phase. So let me reveal to you, this is a very important pattern to become aware of and understanding how the smart money trade. So if you can see over here, price goes into contraction. This is where we get a simultaneous lower high and higher low. This is what we refer to as contraction of price. It's a tightening of price. Some people refer to it as consolidation. And also we get this buildup of liquidity happening at the same time, which will tie into it. But first, you have to understand this three-phase cycle, and then I'll show you this very basic strategy, which will really help you start to win more trades. Once we get this contraction phase, then we get the expansion phase. This line comes out of the center of contraction. This is very important because it lets you know that this is the 0 point in the market. This is where the beliefs become zero. This is where the market makers zero out their balance of their books. And then we get the manipulation phase, which happens next. This manipulation phase is also known as the expansion phase. This is where most traders lose all of their money. There's this whipsawing that happens around value. It's designed to trick you. It's designed to confuse you and take your money. And then once price has manipulated and whipsawed around the value line multiple times, then what it will do, it will go into the third phase, which is the profit-taking phase. This is the phase where everyone makes money in the market. So it's so important to understand these different phases. And once you understand these phases, you can trade each phase accordingly. So phase one, contraction, phase two, expansion, phase three, profit-taking phase. You will see this pattern playing over and over on every time frame, on every pair, whether it's crypto, forex, indices. You will see this pattern playing over and over again. Then the next thing you have to become aware of is liquidity, breakup structures, and market direction. So once you understand this pattern, now guys, we also have an indicator that marks out this pattern for you. If you want to learn more about that, check in the description below. But in this video, I'm going to show you how to manually mark this out on your chart. Most people find it difficult identifying contraction. So let me just quickly show you how to identify contraction. You're going to see price is going to oscillate. As soon as you get higher low and lower high happening simultaneously, you will see we get a lower high over there. And then we get a higher low. Once you get a lower high and a higher low happening, this is where a box gets drawn around, and this represents the phase where contraction is happening because it's contraction of price. It's a tightening of price. So you have to have a simultaneous lower high and higher low. This represents contraction. Once you understand contraction, you draw a box around it, and then all you do is you wait for price to break out the top of the box and the bottom of the box, and then you know expansion has started, and you can draw a line out the center of that box. Now you have an all-important value line. This value line is super important because it lets you know where's the best place to enter long positions. Now you always want to only enter long positions under the value line, and you only want to enter your short positions above the value line. This is what keeps us on track. These value lines let you know where is market value located on the chart. And you always want to enter longs under market value because you get the best price. Want to enter shorts above market value because that's where you get the best price for your shorts. So the value lines really help you just understand where market value is located to keep you on the right side of the market. Then price will usually oscillate 4 to 7 times around the value line before it decides to go into the trend phase. Now, the trend phase is the most important phase because it's the phase where you can make all of your money. But it's important to know what direction is the trend phase going to go in. Now, the trend phase is always going to go in direction with the higher time frame trend. So another important step is you always want to understand what is happening on the higher time frames. And depending on the higher time frame that you consider the higher time frame, whether it's 1 hour or a 4 hour, what you want to do is you want to see these breaks of structure to the upside. If you can see prices breaking these structures to the upside, this lets you know that price is in an upward trend. So you see, if we get, say we're on a 4 hour or a 1 hour chart here, just imagine every time we get a break of structure happening over here, breaking of structure happening, breaking of structure happening. This is letting us know the price is going in an uptrend. And then we want to just focus on trading with the trend. If we focus on trading downtrends, we want to see this downtrend break of structures to the downside. So you can see over here, we got a break in structure to the downside. We got a break in structure to the downside. So this confirms we're on a downtrend. So the first step in this strategy is identifying, are you on an uptrend? Are you on a downtrend? And you can use this price action smart money concept strategy to figure out. We also have tools to help you with this. In this video, I'm going to show you how to do this with pure price action, just using smart money concepts. So the first step is done. We identified, is it an uptrend? Is it a downtrend? Once we've determined whether it's in an uptrend or a downtrend, let's pretend in this example, we've identified it's in an uptrend. We noticed on the 4 hour chart, price has this continual break in structures to the upside. You can mark this on your chart if you like as well. Some people like to do it. You put break in structure. Can you see boss? And then we break in structure to the upside. So we got two breaking structures to the upside. For this trade to invalidate itself, we must mark out the most recent low structure. Price will have to break this structure for it to invalidate the uptrend. So until that happens, we are looking for trades in the uptrend only. Once you've identified that price is in an uptrend, keep that in mind, and now you're only looking for long positions. And now what you want to do is, now this is where you can apply the master pattern concept strategy by using this 3-phase cycle. What will happen is, since on an uptrend, you'll notice price will make different kind of patterns. It might make a swing low, come back up, and then it will start to create contraction. See, contraction will happen. And then you just mark a nice little block around that contraction phase, whatever color you want to do. I like to use green for this. And then we have contraction happening. Now you also want to know where to mark out order blocks or supply and demand zones. Usually you put an order block over here. Usually order blocks come near liquidity zones. So you can either focus on liquidity or you can focus on order blocks. But this is usually the region where order blocks happen. There's a lot of different videos out there. I have a few other videos going into detail about how order blocks work and how to mark them out, but it's fairly easy to recognize. So say, for instance, we get an order block or a swing low. This is where liquidity is located, because think about it. Most traders place their stop losses at these levels. So these are important levels to realize that price likes to go back to these levels to grab the liquidity before it moves and continues in the uptrend. So once we have this contraction box marked out, we draw a line out the center, because then we get the market value line, which is super important. And then you'll see price will go into expansion. In this expansion phase, price can also start to whipsaw down to collect the liquidity at the liquidity line or into the demand zone. Because what you have to pay attention to as well, in this contraction phase, we get equal lows or we get liquidity building up. Liquidity is when we get this kind of scenario happening, where we get this consolidation or contraction. And then what it's doing is actually building up liquidity. You see, these are liquidity areas being built up. So you always want to see this liquidity building up, and our indicator marks it out. This is these contraction zones are where this indicator is marking out these levels. So we know that this liquidity is being built underneath these contraction areas or consolidations, and their price at some point has to dip down, break these structures, because you can see, look, these lows is where liquidity is building up. We know liquidity, wherever we get equal highs or equal lows or liquidity building up, price has to break those structures to go collect the liquidity. And we know at the bottom here, we have a liquidity line located located. So we know price is going to break structures, dip into this. Either it's going to be a fair value gap. You'll get fair value gaps located over here. So those are two things to pay attention to. It's either going to be a fair value gap or it's going to be a demand zone. Taps into liquidity, fetches liquidity. Remember, price is under the value line. When price is under this value line, that means you're only looking for long positions. Also, keeping in mind that we are on a confirmed uptrend. So these are going to be our best positions to start looking for our long entries when price is under value line, tapping into either liquidity lines, supply or demand zones, or these fair value gaps to fetch the liquidity. And then we see price will make its move from here and then continue into the trend phase. So we get phase one happening with contraction, phase two happening with expansion or manipulation, tapping into the demand zone. And then we have phase three happening where price is going to go into this profit-taking phase where it deviates away from the value line. So this is the complete strategy. You want to keep in mind this three-phase cycle. You want to understand where are supply zones, demand zones, where's liquidity located, and then you can understand what is the direction of the trend, what is the bias of the markets. Let's jump onto the charts now, and I can show you an example of how this works. We're on the charts right now, and I'm looking at a cryptocurrency coin called GOAT USDT. This is a fantastic example. I'm going to show you exactly how the strategy works. So if you can quickly look at this, I'm going to show you the structure of it, and then I'm going to break it down, and I'm going to show you how I was able to figure this out. You can see we're in a confirmed uptrend. We've got higher lows, higher lows, higher lows, higher lows, and at the top here, we've got higher highs, higher highs, higher highs. This confirms to us that we are in an uptrend. So it means we're only looking for our long positions. And then what we do is we wait for a break of structure to happen. And you can see over here, we've got a break of structure happening to the upside. Can you see we've got this very volatile move to the upside? We've got displacement, which breaks structures. Whenever we get displacement like this, it leaves behind an order block. So the best order blocks are going to be those left behind that have fair value gaps. Can you see we've got all these fair value gaps, and then we've got an order block left behind. Usually this is at the swing low points, and it usually can be the last down candle before the up move or the last up candle before the down move, or it can even be the actual fair value gap candle itself. So this could also be an order block over here. Sometimes it can also be doji candles, which are indecision candles. So whether it's there or here, we can take this whole piece, and this becomes our point of interest zone. And then you can see price goes up, and notice it's forming more liquidity. Whenever we get these trend lines formed, that is liquidity, and price always likes to break liquidity. And then we get a huge drop over here. Can you see we get another break in structure to the downside? This is another break in structure to the downside. You can see break-in structures with volatility, with displacement. Comes down. Whenever we get these break-in structures, it leaves behind these order blocks. So we mark out that order block, and that becomes a potential point of interest zone. And here's the most important part. Price drops down, and look, it starts consolidating, and it forms a contraction zone. Simultaneous higher low and lower high. We mark a box around it. We draw a line, which is our value line that gets drawn out the center. Value line. Now we know whenever price is underneath this line, this is where we're going to look for our long position. It also forms liquidity. So this liquidity is very important. Whenever price creates consolidation, forms liquidity, we know price is going to take that liquidity out. So we're expecting price to take out this liquidity, to tap into this demand zone over here, and then to retrace back to the value line. Price loves to retrace back to value multiple times. If you can see in this example, below value, above value, below value, above value, below value. So we've gotten multiple interactions with the value line. So this becomes a significant magnetic level where price likes to come back to. And we anticipate that. So you can see we would have entered exactly as price tapped into this zone, took out the liquidity, and our target would have been, we would have said stop loss underneath the demand zone. Our first target would have been the actual value line. This is the highest probability target we can create, because price loves to go back to value. Otherwise, the second target would have been the first liquidity line. And you can see this would have been an absolutely massive, massive trade. So now I'll break it down for you and I'll show you exactly how we put the whole thing together. So you can see once again, we're in an uptrend, confirmed uptrend, because we have these higher lows and higher highs forming. So we're in an uptrend. We can see over here, we get break of structure, which is this massive displacement that is formed. Once we get massive displacement, we know a zone is left behind. We mark out that zone. This becomes our point of interest zone. Once that zone is marked out, we can also keep track of all the liquidity that's taking place. You can see this trend line is broken and price drops down, and then it starts creating this consolidation. Can you see this is consolidation now? Consolidation is letting us know that the market is building liquidity. And when it builds liquidity, it always likes to take out this liquidity. Then over here, you can see we get our first lower high and higher low that's formed. Sometimes it's a little bit tricky to pick this up. Like I said, we do have an indicator that does this for you. If you want to check that out, the link is in the description below. But you can mark it out yourself if you enjoy marking out the charts like I do. And then we can mark out the value line. The value line is always projected out the center of this contraction zone. And then you can see we get price whipsawing around this zone. Since we know there's liquidity over here, we know price is going to break this level. Price loves to break out and break below liquidity. And since we've got this point of interest zone, we know as price breaks below the zone to take out this liquidity and tap into this demand zone over here. We want to enter our long position right over here as it taps into this zone. What we do is we enter on the zone, stop losses underneath the zone, and we target the value line as target number one, or our second target is going to be the first liquidity line. These are the highest probability areas of making good profits. You can see this trade played out absolutely perfectly. But things to keep in mind is, number one, the direction of the bias. You always want to trade in alignment with the bias. Number two, you always want to look for this building up of liquidity and look for the first phase in the market cycle. And thirdly, you always want to mark out your demand zones and find out where price is going to go to tap into this liquidity before it moves back to the value line. This is a super simple strategy. It's very, very easy to utilize and to make good profits. If you want to learn more about it, check in the link in the description below. We've got a full training course on this and indicators and many, many tools to help you become a successful trader.